Welcome back to Palisade Radio. I'm your host, Tom Bodrovics. No animals were harmed in the making of this recording. Joining me today is James Anderson from SDBullion.com. He's a precious metals researcher, content creator, and physical investment grade bullion professional. Thanks for joining me today, James.
Thanks, Tom. Thanks for having me, and hello to all your listeners out there.
So before the call, you shared with me an interesting story about how you really got interested in this market. And we're talking a little bit about how gold and silver are a gateway into really understanding the world. And it kind of seems like you had a little bit of a path in that same vein. So could you share with us how you started to get exposed to this industry?
Surely. Back at my granny and granddaddy's house in Tarboro, North Carolina, we'd go there occasionally on holidays and visit with them. And when you're a little kid, you climb and crawl through everything and open up drawers you shouldn't open and open closets you shouldn't look in. And inside one of the closets, I bumped into a huge bucket of constitutional 90% silver that was being hoarded. And I pulled it out and felt like I was a pirate who just hit a big score. But, you start asking your dad about it and you start asking questions, and it leaves a seed in your mind. I mean, you're like a 4 or 5 year old asking these questions, 6, 7 year old. And every time you go back to the farm, you'd want to see that silver. It's always fun to play with, et cetera. You know how children are. But then as you grow older, you start to really percolate and think about that. If you get interested in finance and economics, then it makes it easier to fall down that rabbit hole of understanding an alternative story about kind of how we got where we got in terms of the economy today and the history about it. So I'd say from there, the progression to going to college down in Loyola, New Orleans, a bunch of my professors had Austrian economic bend. And so they would teach the Keynesian spiel, but they would also give you a counter argument in the Austrian school. And so you got taught, to think critically about things, not to simply just take the Keynesian line. So that was helpful too in opening up my mind. Even one of the professors there, I think, was the economic advisor. Walter Block was the economic advisor to Ron Paul in this 2008 campaign, which I graduated in 2002. I traveled and lived in Central America, South America. I got to learn a little bit about the history down there. And then when I was in LA in 2007, got involved with the Ron Paul campaign, and that was an excellent experience. So, not in the sense of the way that the political class treated Ron Paul, but it was an excellent experience in terms of the energy that his supporters had, in terms of the words that he said and what he did. So I would say those are kind of the way I went down that path. And then by the time 2008 rolled around, I was investing in precious metals anyway. I was so interested in it. I figured, why not get a job full time in it? Because I'm such a nerd about it, I guess. And so that's kind of how one thing led to another. And the next thing you know, I'm working in the industry, and trial by fire, perfect timing. September 2008 hit, and I was in the right spot. Cut my teeth in a trial by fire situation where the phone wouldn't stop ringing, and there was a lot of bullion sales to be making. So it was a good experience in terms of my start in the industry, and been in the industry ever since 2008.
Interesting, James. One of the pieces that I think you've really highlighted well recently in your videos over at SD Bullion, I suggest everybody go look at them. You do a great week in review and really highlight anything important that happened during the week. But you're painting a very big demand picture. So can you tell us a little bit about what demand has looked like already this year? We're now in the beginning of October. We've seen the first 3 quarters of 2020 as violent and volatile as they've been. So what has the demand picture looked like, especially from the ETFs, funds, and commodities side?
So if you totally add up, for instance, the ETFs, the funds, the exchanges like the Comex, et cetera, they've all been adding profusely pretty much, especially since COVID has occurred. Obviously the spot price crashed during the COVID beginning in March, and a lot of people saw that crash happen and they knew there'd be more QE to come. So they knew what happened last time when there was a huge spot price crash in fall of 2008, and they know what happens after a huge QE response. Typically silver starts to go berserk, and that's exactly what it did. It went down to 13 or 12, and the shortage in the retail bullion industry became acute, just like it did in fall 2008. And we've shot up more than doubled the spot price in a short time frame. And obviously we're consolidating now, but we have over 200 million ounces that have flowed into ETFs and into the Comex throughout this year. We're only 3/4 of the way through, right? So what will happen? Oh my God. I have to go downstairs. I'm sorry. My cat just fell out of a window.
Oh my God.
1 second. Yeah, I'll be right back.
Yeah.
A few moments later.
Okay. Thankfully, the cat is okay. No broken bones.
Landed on its feet.
I think he landed on something that was perfect. My car cover plus some cushy things and on a slant. So I think it broke its fall and it slanted off into the grass. It's sitting on a table. It was absolutely perfect the way it landed. I think it's okay. Had it been not there, it would have been real trouble.
Yeah. How far did he fall?
It's from the second floor to the first, so.
Oh man.
I mean, it's a good 12 feet, I think. There's no way that guy would have landed not with some real problems. That was perfect. Like if I was going to design a thing where you drop an egg and it doesn't break,
Yeah.
That would have been about what I would have tried.
So, how lucky was that? Jeez.
That was lucky. It was. I made the mistake of having him up here and the window was open. He's climbing around behind the computer, and then I see him out in the bars of the window, scraping, trying to hold on. He just vanishes. I'm like, oh God. All right. So I was going along about the over 200 million ounces flowing into various ETFs and commodity exchanges. And so obviously there's a lot of doubt in whether or not that's even happened. I mean, there's a lot of people in our industry who hawk this stuff, including myself, who have our doubts in terms of, when I talk about ETFs, the biggest one by far is the SLV, which is the custodian, obviously, is JP Morgan Chase. And so even if they have theoretically added as many ounces as they claim, which is upwards of 150 plus million ounces, where would they have gotten that? The only place they could have probably gotten that was from JP Morgan. And so JP Morgan's not only a custodian, they're also an AP of that fund. So they have the ability to add or withdraw from there. And so I don't really trust JP Morgan. I'm sure most people out there don't. So SLV is not only a derivative I don't trust, it's one I wouldn't buy or hold, even on a short-term trade. There's other better proxies for silver than SLV, but people don't do any research or anything. So they just buy SLV because it's the one that most people know. But digressing back from that, though, the Comex as well has been adding a huge amount. They're at record levels as well. I think over 380 million. JP Morgan, their Comex holding is over 180 million now. So it's been increasing in the last month or two. And obviously they got fined almost $1 billion by the Department of Justice and the CFTC for manipulating the precious metals for over 8 years, roughly. And obviously they also paid part of that fine for manipulating the treasury market. It's absolutely insane. And $1 billion, it sounds like a lot, but if you're doing it right, you could make $1 billion rigging the silver price downward typically, or gold. Doing it over a week, you could make $1 billion if you make the right bets. So, in a week's time, I'm talking about 8 years that you were doing this. So it's just a slap on the wrist fine. And not yet has anyone gone to prison. So it's very easy to look at this market and to be cynical. Ultimately, I see the demand and the flows that are supposed to be happening. And my hunch is that the more and more people are going to continue coming because the QE is not going to stop. If you look at the fundamental factors of the economy, we're well off what we were beforehand. And the unemployment's still massive. And the economy is just structurally not as sound. It's changing. And there's going to be years of underperformance. And they're going to have to, pump more currency into the system. And so that's inevitably just going to bring more bids to silver as a monetary stored value. And then there's other factors in terms of the inputs in the economy, in terms of solar panels and batteries and all the other things that silver has to go into. And as we move further into a world where gizmos and gadgets get even more profound in what they can do, silver is going to be required. So I have no doubt in my mind long term that silver is going to perform both ways. My hunch is a lot of the silver that's being held as a store of value right now, there's like a handful of billion ounces sitting out there amongst these ETFs, these exchanges and private holdings, maybe 5 billion ounces if you added up some junk silver too, and refineries were able to melt down some of it when the demand was hot. I imagine a bunch of those billion ounces of silver are going to end up going back into gizmos and gadgets as we grow older in our lifetimes, and it'll be at a much higher price than it is today.
Absolutely, James. And as you're speaking about the real demand picture, you recently also highlighted that Leon Cooperman, along with Warren Buffett, they're both billionaires and they're getting into the precious metals industry. They're more interested in gold, obviously. But is this a sign of things to come? Are they basically just trying to hedge their risk by getting into gold because they're worried about who pays for the party when it's over?
Yes, that's certainly a concern. I mean, Warren Buffett's one of the guys who used to run around saying, never bet against the United States. And right now he's basically betting against the United States, buying up companies in Japan, buying shares of conglomerates there who have small mining exposures. But, the Barrick thing was a big sign. Anyone who knows anything about Warren Buffett knows in the 90s, he went huge long in silver. I think Berkshire had 129.7 million ounces of silver in their fund. And that silver ultimately got sold in 2006 and Bullion was the beginning of the SLV ETF that we were just discussing. And so it's basically a fund. I mean, he had a size of silver in the physical hoard sense that was even larger than the Hunt brothers had. I mean, the Hunt brothers maybe got 100 million ounces in silver and bullion, and they had another 100 million ounces in derivative exposure. Well, Warren Buffett had 129.7, and now JP Morgan in their Comex warehouse has over 180 million. So obviously we don't know how many clients or which is their account and which is the client account, and we don't know how much they have in London. They probably have huge swaths of silver in London that no one knows about except for them, and they don't have to report that to anybody. It's not really transparent, but we've been watching the data for, especially guys like Ted Butler and others have been watching the data for years and years and years, and they've been withdrawing a lot of silver from the ETF for years. So the hunch is that JP Morgan has a lot of silver and gold as well, and they've been hoarding it, knowing that this turn was eventually going to come, and to have it as an exposure for profit in the future. So they got it at a discount, and it's a safe long-term bet. I believe that's the way JP Morgan looks at it as well. It also helps them to control, and they can move the price up or down, given the fact that they have so much physical to deliver if they were ever called upon to do so. So yeah, you have billionaires like Scott Menard. I mean, Scott Menard, he is what I would say is now essentially the bond king of the, Bill Gross used to be the bond king. Now Scott Menard's the bond king. Basically, he's the guy. And bond traders are like the sharpest people in the entire financial game, basically. And when you hear that guy talk, I mean, he's a super silver bull. And when he talks about silver, he's been talking about silver on record for years, since 2011, 2012. Late in 2011, he was on Fox Business News saying, silver was at like spot 30s. It had just come off its 50 high in the spring, and it was early fall. It was at 33, 34. And he's saying, silver, if you look out 10, 20 years, he said silver has got the potential to go to $500 then. And he was explaining why. The guy literally sits now on the New York Federal Reserve's investment advisory board, right? So it's just like he's one of like a handful of people who are these billionaires who meet up, and it's a nice thing to be named whatever, the New York Fed. And he seems like an honest guy. Like the fact that he literally gets on TV and tells people, like in 2020, early before COVID even started, he got on Bloomberg when they were at the the Geneva, Switzerland, one of those meetings, the Davos thing, and they asked him, and he said, they're like, "What's your bet for the year? What's the one that you're betting on? What's the one investment?" And he just said silver, which is a very strange thing. The announcer or the person who was talking to him, the interviewer, is like, "Well, silver, why not gold?" And I mean, it's simple. Obviously gold is going to be hitting its new nominal price high very soon, and silver is well off its old nominal price high. And so that's basically, he was betting on the value bet that silver would recapture its old nominal price high and probably blow beyond that. Because at the end of the interview, he asked him, well, do you think silver has the potential to go exponential like the other metals? And which he's saying is, do you think silver is going to go exponential like palladium's been going exponential? And he says, Scott Menard basically said, yeah, it's very high chance it will. And so for your billionaire to talk like that, pretty aggressive, especially pre-COVID. And it's obvious. I mean, any billionaire, I think, in their heart of hearts, they know they can't just go crazy silver bull or crazy gold bull and just be out there doing a Hunt brother job and ruining the system, right? So they can't be, the system that made them so wealthy is exactly, I mean, that's the financialization is essentially what makes most of these people really, really wealthy in like disgustingly wealth terms. I mean, the leverage that they have in the financialization of this economy, and for them to turn around and double cross that would probably it wouldn't be a good thing politically for them to do. And they would probably end up having a lot of things happen to them that we would never know the truth about. It would be similar to the Hunt brothers. If you know the history of the Hunt brothers, they essentially got scapegoated, they dragged out into court and their names just turned to mud because they were the easiest target in terms of trying to point at someone that was a speculator that almost trashed the dollar, when the truth of the matter is the dollar was getting trashed because of all the poor decisions we made after World War II. So, yeah, the idea that billionaires are not going to be coming into gold and silver, slowly but surely they will. And they'll probably start moving into miners, because miners is going to be the easier way without, making the spot price go lopsided. But I've been watching this. This happened for the last few years. We've seen massive whales come into the silver ETFs and withdraw silver out of the ETFs. So this has been happening and building for the last few years. It's not just simply post-COVID. We've seen a huge jump pretty much since 2016, basically roughly 2016, 2017, 2018, we've seen big chunks come out of investors, large investors come into the ETFs and put in big plays. It's only been in the last 6 months, it's gotten really obvious with hundreds of millions starting to move in terms of bullion.
So as you were talking about Warren Buffett basically betting against the USA, James, give us an idea of, let's say, the loss of purchasing power of the US dollar versus gold.
So obviously gold for a long time, longer time of our American history has been priced at $20.67. That was like the fixed price for gold up till, obviously 1933. It got changed in the nationalization or confiscation of gold in 1934. It got moved to a fixed price of $35. So just take the $20.67 price and subtract it by gold, is at the spot price. I mean, whenever we get above $2,000 an ounce for gold, basically the US dollar has devalued 99% versus that old $20.67 price. So I point out to people, look, I mean, obviously the Federal Reserve note now, the fiat Federal Reserve note has devalued hugely, big time, since 1971. But ever since pretty much the Federal Reserve got involved in 1913, things have been going wrong for the purchasing power of the circulating currency in the United States. And we've already pretty much lost 99% versus gold. And the question is, how much longer will it be for that last percent? And the trend is obvious. The only question is exactly how much longer. And it's a mug's game, I think, to sit around and think that last 1% is not going to get carved out at some point soon. So for me, when I look out in the future, you don't want to go all in gold and silver, but having a prudent position of, say, 20% of your liquid net worth in bullion, I think makes complete sense right now. So that's basically the tenet that I go with. It's something, it's not super aggressive, nor is it super conservative. You ask most people, they use the old 1970s line, like 5-10%, which if you go back and do the research, it's not enough. 5-10% is not covering what we're probably going to go through in terms of the other financial classes, how they're going to perform versus bullion. You're going to want to have more exposure, I believe.
And one of the other kind of threads I wanted to pull there of something you mentioned earlier, James, is the gold to silver ratio. And you talk about the gold to silver ratio basically collapse. So what is it now and what should it be?
So I don't necessarily talk about should, because gold silver ratio is a historic thing. It's been around obviously since written history, right? We've been trading gold and silver for over 5,000 years, going back to ancient Egypt. And when ancient Egypt began, at some point, it was almost 1-to-1, the ratio. But that's obviously something local, like how much silver were they finding, how much gold were they finding, and a lot of times it was mixed. And in the beginning of ancient Egypt, they didn't know how to separate electrum. Electrum is basically the way you find a lot of gold and silver kind of mixed together on, say, for instance, if you're at a riverbed and you find this shiny rock, and it could be electrum, et cetera. So we have a situation where the ratio has been from 1-to-1 in ancient Egypt all the way to, recently we hit, I would argue, almost the all-time high. I think in the Great Depression, there was a little bit more, but both we've had a double top essentially in the gold silver ratio from the Great Depression to this newest Great Depression, essentially. In the Great Depression, it hit about 132 or 133. I'd have to go back and look at the data. And I think here it peaked around 127, 128. And that was not long ago. Obviously, it happened in March. The idea of having a gold silver ratio in the hundreds makes absolutely no sense. If you're talking about in situations and eras when you have monetary demand, if you have a situation where the currency is in real question, what happens typically is that people start running toward gold and then they run to silver as gold gets overpriced, or as gold just gets more and more expensive. It's not to say that gold anywhere $2,000 is anywhere near overpriced. Gold is still super undervalued if you compare it to the amount of currency aggregates that are out there. And gold could easily threaten $10,000 an ounce if things go the right way in terms of, how much more are they going to create? The seeds have already sown pretty much for it to go to 10,000. So it's a question of what's going to happen. But for me to look out and see $5,000 gold, $7,000 gold, that will not surprise me. Maybe for the first few days, I'll look at a price like that and it might kind of blow my mind as the price is going exponential. But this is what we've been preparing for decades. There's been people who've been saying this was common since 71. Once you go full fiat currency, Jack, this is where you're headed. You're headed to a situation at some point where currency is going to get called into question. And the fundamentals here, if you look at all the fundamental drivers going on, this is a perfect setup for gold and especially for silver too. So I think the current GSR, what a lot of people call on a short gold silver ratio, is right around 80 right now. We got down to like high 60s recently. But when I look out in terms of the future for the gold silver ratio, I think it's a safe bet that the 2011 low of gold silver ratio, when it hit 33, I believe in April of 2011, when silver threatened the old $50 price high from 1980 and then got beat back by a lot of sell-offs and such that happened in the derivative complex. So my contention is that, yes, 33 gold silver ratio is going down at some point. And the question is, how much further will it go? 20s, I think, is possible. Teens even. A lot of people talk single digits. I think that's a little bit out of control. I think a safe bet is to think 20s. And at that point, you better start looking around and taking some profits and moving into something else, because by that time you're talking about probably in the beginning of a raging commodities bull. And so it's a question of where else may there be good value.
So, James, as we talk about how much demand there is right now and how much silver has been stockpiled by ETFs and all these other vehicles, how do we think about the price action and price discovery of silver being broken right now, and who might be responsible for that?
So the price discovery of silver is mainly set on the Comex. Okay. And if for anybody who understands anything about the Comex and its history, there was Julian Assange's Wikileaks dumped a treasure trove of documents on us in the last decade or so. And I was personally the one digging through it one day because I was just interested in to find what documents he would have on gold. And I was the one that dug up this document that basically showed a meeting that happened in late 1974 in the city of London with gold dealers and agents from the U.S. Treasury. And it's a document that is cables going from London back to the U.S. Treasury. So these are Treasury cables. I mean, this is government documents documenting exactly what was going on. It was a meeting at the end of 1974. The gold price was right around $200, raging from 35 only a few years prior. And the U.S. Treasury was obviously concerned and worried, and they were trying to figure a plan to kind of quell the gold price and figure out how to deter people from going and buying gold bullion, which is just about to get re-legalized in 1975. And so they were worried that it being legalized again and people being able to hoard more than 3 troy ounces at a time, they were thinking, oh gosh, we could have citizens piling into gold and we could have a stampede away from the fiat Fed note in our own land. That would be real trouble for the demand for our currency. So they were worried. And the meeting notes just essentially show that the London gold dealers suggested that they create a derivative market that was much larger than the physical market. And that would then therefore inject volatility into the price of gold and scare the living bejesus out of retail investors from thinking that gold was a good alternative to the fiat Fed note. So what you see is the Comex gold market started in 1975, and you see the price immediately half in the next year or so. It goes from 200 to 100, essentially. Obviously, it rebounded from 100 to over 800 in a matter of short time thereafter. And obviously, the powers that be kind of lost control on the gold price. And obviously, the federal chairman, when he was showing up in the late 70s, I'm forgetting his name, the very tall gentleman who used to smoke and wear glasses. He passed away recently. Anyways, he would show up at the office every day and ask his underlings, what's the gold price? That's the first thing out of his mouth. Paul Volcker is the gentleman's name. So anyway, the whole point of this is to say that the Comex was set up essentially to help create demand for the fiat Fed note and to help basically have a guide or control on commodity prices. And most important of all commodity prices, really, aside from interest rates maybe, or the price of gold, the price of silver, because those two are competing stores of value demand. And so it's gotten more complex in time in terms of the controls that they use on the Comex and the banks, that what they allow the banks to do, either in their own account or for other accounts that they are proxies for. So it's complex. It's gotten much more complex in the way that they are able to move the prices of commodities, especially silver and gold, but many others too, as well to derivatives of interest rate derivatives. They can move FX. They can move pretty much any market that derivatives are traded on. Comex, NYMEX can be moved given the programs that are available now to these foreign central banks through the CME Group's central bank incentive program. So what I'm basically telling you is that, in the short term, the price can be dictated and moved. But in the long term, what we're running into and what we already have run into in some of these markets are just shortages, flat out shortages. So if you look at the palladium market, for instance, that went exponential in the last few years, the idea that palladium is more expensive than gold is absolutely nuts. But that's the situation we're in because there's a huge shortage in palladium. And there's an acute shortage probably because the palladium price has been depressed for far too long. And you have a situation where palladium only comes out of a few countries. And, there's probably limited stockpiles. The ETFs for palladium have been raided, essentially. So you go look at the hordes of bullion that's supposed to be sitting in these ETFs. It used to be much larger. Now it's been raided for industrial use. So I see the same thing coming for palladium. The same thing is coming for silver, for gold, and for platinum eventually. We're going to have a situation where there's going to be a run on physical, and there already is. It's just a question of, who's getting the physical and who's lying about how much physical is moving, et cetera, et cetera. But we're going to come to that day. We already have. When you have a situation, for instance, when COVID hit, to have a shortage as acute as we had in the bullion markets, in silver and in gold on a large wholesale level, it just shows you that we're dealing with a situation that's when real outsized demand comes, they cannot deliver on. And that was not the ultimate outsized demand. The ultimate outsized demand is coming when we have a financial crisis and we have a currency crisis. That's going to be the all-timer. And it's going to play out. You're going to have a situation where there's just not going to be enough physical. And so your choices are going to be proxies, derivatives, et cetera, or some minor this or that, So we're headed there. That's ultimately where I think this goes. And there's this situation where people think that, JP Morgan has ultimate control over the spot price forever. And that's a whole bunch of hogwash. I mean, it's like saying the London gold pool is going to forever keep the price of gold at $35 an ounce. It just doesn't work. That's not the way economics work. Eventually, things don't work because you run out of physical. So it'll be the same story. It'll be just a different rhyme or reason, but it's coming. And it'll mainly be because people don't trust the currency that they're being handed in trade. They want the real thing. They want real money. And that's what I believe is going to be coming.
Absolutely, James. And it can only be a matter of time before that supply-demand picture really breaks. And I like the way that you put that we should maybe rename the Comex the complex, because it's so difficult to understand and they make it so opaque to be able to really see into how much physical there is, or if they're going to be able to keep delivering that in the future. You recently also included an article about interactive brokers increasing their margin requirements ahead of the election. So why would they start doing this, and what could it mean for the stock market coming into October here?
So I think conspiracy theory out there would say that they're doing it because they want to get Trump out of office. That would be the conspiracy theorists out there that were thinking that. I really think it's a question of October. They know is usually a very volatile month. They see the amounts of leverage that these retailers are using, and they know if things get really wrong, these retailers are going to get wiped out. And then the question is, can we go and take the retailers in court? It's like, that's a big mess. They don't want to get involved in. So they had to kind of deleverage it a little. But it doesn't matter. I mean, these retailers, I just saw a chart the other day, like it wasn't Interactive Brokers, it's another one of these brokerages. But the amount of leverage that some of these knucklehead young retailers are putting on is, we're headed for a train wreck. There's going to be another downside move. And a lot of these people are going to get wiped out and learn things the hard way. They think the Fed has their back at all times. That's just not the case. The Fed's not that quick. There's going to be a time and a place where it's going to go waterfall decline, and a lot of these people are going to get their faces ripped off. And that's typical. In a crazy bubble era, you're going to have people doing things they should not be doing, people doing things that are not safe. And so I just think it's a sign of the times. We're moving into October, and we're moving into an election cycle that could be absolutely chaotic all the way into January.
So in the interest of not getting our faces ripped off, as you were saying, James, what are some of the best ways, in your opinion, to preserve some of the current purchasing power that our fiat has?
So there's studies out there, and Jeffrey Christian of CPM Group published it. I've covered it on SD Bullion regarding gold and silver allocation, prudent gold and silver allocation. If you simply searched SD Bullion gold allocation, you'd find the article. It's a study that goes back 1968 to he updated it all the way to 2020, the last update he did, but I think the article is up to 2017. And it just shows in a full fiat currency system from 1968 up until present that amongst the S&P 500 index versus U.S. IOUs, bonds, treasuries, et cetera, notes versus bullion, various mixes of precious metals. I believe he had over 500 different portfolios he did back tests on. The greatest risk reward over that roughly 50-year time frame was simply having 20 to 25% gold allocation, gold bullion, just straight up for 50 years. That would have been the best risk reward in terms of performance. Obviously, the rest would be in bonds and in stocks, et cetera. But if you look at the situation right now, I mean, just think about it, the bond market and the stock market, and how long do you think they can keep this propped up with the currency going wrong? That's the idea. And so I'm not telling you to go all in gold or silver bullion, but I'm saying you should be thinking about getting very aggressive with your liquid net worth and putting a prudent position. And I think a prudent position, based on the data that Jeffrey Christian published, is 20%, a mix of gold or silver, what have you, depending on your age. Older people should probably stick with gold because it's going to be much more of a calmer, less volatile trade. And you won't have a situation where it moves so fast downward or up, given volatility. Whereas if you're someone younger who has more time on their side, you can wait a decade or plus. Silver, you might want to get aggressive in, because I just think a decade from now, it's not going to be anywhere near 24 spot. It's going to be a lot higher. So it's just a bet that is a safe bet that you can take fully outside of the financial system and have in your hand, or have in a non-bank storage account in your name directly. And when I say non-bank storage account, I'm talking about a Brinks or a Loomis or a Malka Amit or a G4S account, something that is completely outside the system with no middlemen, and people that are proven to do this type of work for hundreds of years. So that's it. It's a prudent way to make sure that no matter what happens, you're going to have bedrock of your wealth is going to be maintained. It cannot go to zero. In really bad situations, it outperforms everything.
And you're really trying to highlight there, basically eliminating that counterparty risk. So if that is the case, where we're trying to eliminate our counterparty risk, explain to us why, SLV and ETFs like that are not a good proxy and not a good, let's say, safe place to really store your quote unquote wealth.
Yeah, so if we're talking about this 20% position in bullion, I like to say bullion because that's what I mean. I mean physical precious metals bullion, because it's something that you could hold in your hand, or like I said, in a non-bank storage account direct. And it's the counterparty risk is only in the sense that, the people looking after it, they're doing their job, they're good service people, and they have full insurance if something goes wrong. If you have it at home, your counterparty risk are the people that possibly, sometimes, sadly, some people that are in your field of acquaintances or people that are even in your family. You kind of have to keep it a little bit hush. I think when it comes to bullion, it's kind of a private affair. Only your closest loved one or your will should know about this. You wouldn't want to go around telling other neighbors, et cetera, about your big position that you have in your house. That's setting yourself up for real problems. In terms of the ETFs or derivatives in general, it's okay, I think, if you have some speculation on the side, if you want to gamble in terms of short-term swing trades. I don't think there's anything wrong with that. For instance, if you have 10, 20% your net worth in bullion, but you want to have 5% for swing trades or for miners, et cetera, I think that there's nothing wrong with that. And the question is, well, what would you use? What proxies for derivatives? Because you wouldn't want to be trading bullion. The bid-ask spreads are just too large to be trading in and out of every, say, few months or every year or so. So you'd want to select proper ETFs. I've done research on the topic and made a post on, you can simply internet search SD Bullion silver ETFs or SD Bullion gold ETFs. And I give a breakdown of some of the largest ones and also what their management fees are, because people maybe they don't even think about every year. If you own SLV, they're taking 50 basis points. And I know that goes right over your head, most of you. 50 basis points is really complex Wall Street speak for I'm taking a half percentage of everything that's in that account. So say you have $1,000 in SLV. Well, next year you have whatever that math is. Obviously, it'd be a percentage of 0.5% of that would be taken. So I'm getting stuck here. It would be 900. Do the math real fast. So if you have $1,000 and you'd end up having 995. So every year, slowly but surely, you're getting siphoned some of your wealth sitting in there. So look, I just think SLV is probably the worst of all the ETFs out there. I just don't think it's something you should trust. And there's other ones that are better. I think Sprott runs one that's much better. PSLV is better. And there's others even that I put in the article that you could consider. But when it comes to SLV, you have to look at who's in charge. And who's in charge is JP Morgan as a custodian. And then who are the APs? A whole bunch of banks that have paid massive fines for manipulating precious metals are APs, which basically means that they can go in there and actually take the physical, whereas you retail Joe Schmo, you get no physical for nothing. All you get is an unsecured share. You have an unsecured share, so if things go wrong, you have no recourse. And that's basically where you are in legal terms. So I don't like those situations, really. And so if I'm going to use a derivative, I better know who the counterparty is, and I better trust them. I don't think Eric Sprott is going to be backstabbing his shareholders in the sense of something really bad happening. So I would say if you're going to go trust someone, you kind of have to learn who the actual authorities are of those exchanges, what the prices are, what they charge per year, et cetera, and make your swing trades based on those choices.
So when we're talking about buying actual physical bullion, James, is there anything that people should watch for? Is there one type of bullion that's better than another?
Yeah, so on SD Bullion, if you went to our website on the far right under resources, I've done a whole lot of work for people who perhaps are thinking about and considering, getting into bullion, they're first timers, or if they've been in it for some time and they still want to learn. There's a lot of information in the investing guide section under resources. And in that investing guide section under resources, I have little buckets and little blogs that you can read. One of them talks about which bullion products are best. Another talks about industry pitfalls and poor practices. Another talks about IRS privacy, depending on what products you sell to a dealer, depends on whether or not they file an IRS report, et cetera. So there's a lot of complexity, and it's something that to answer your question, it would, to do it thoroughly and right, we could probably sit here for hours, but to do it in a short, condensed way, essentially, when you buy gold and silver, you want to get products that are well-known, well-trusted, that are close to the spot price. You want to get something that's reasonably close to the spot price. You don't want to be buying something that is collectible or some type of premium product. There's only been X issued. And so therefore, the salesman's going to tell you that for that reason, it's going to be worth so much more in the future. There's a lot of poor business practices in the precious metals complex, let's say. a lot of dealers who learned how to hook and crook customers from the 1980 bear market through 2000. And then a lot of those businesses are still around. They've not been shut down yet. Some of them have, but there are a lot of industries players that will have no issue essentially taking half of someone's IRA by selling people products they should not buy for their IRA, right? And they have no qualms doing this. And this is something that totally breaks my heart when you see this, but it's still going on to this day. So when you're going to buy precious metals, you got to know the dealer is trustworthy person, trustworthy company, et cetera. And secondly, when you're selecting the products, you might want to consider, what are your objectives when it comes to the products? Are your objectives, do you want to have something, there's people out there who think they're going to end up using silver in a currency crisis in the streets. Okay. All right. I'm not sure I necessarily agree, but that's fine. There's people who think that. So maybe they should consider junk silver. That's a pretty good play. If you're in the United States, most people recognize a pre-1964 constitutional silver, and they probably could use those as a way to transact in the streets. If you're talking about, for me personally, when I look out and I think about what are the best products, the number one product, and I've done articles on this, top 10 bullion products at SD Bullion. You can search that if you want. I did a long video on it and show you the various products and talk about why our customer base buys these products and what they think about them and the pros and cons, et cetera. Some of the products are more expensive over spot versus others, but then as well, when you go to sell, you get a lot more back when you go to sell versus others. So for instance, like a complex explanation of why I like American Silver Eagles more so than virtually any other silver product is because when their premiums are low and reasonable, which they probably are not right now, if you look at how much they're priced over spot, but when they are more reasonable, I like to buy those. I mean, I was getting them at $2.20 just a year or two ago over spot, $2.20 over spot, right? And then recently in this COVID shutdown and the premiums jacked out over $10 per ounce over spot. So you can play an arbitrage. You can sell, say, Silver Eagles and then take the proceeds and go and buy 10-ounce bars if you'd like, generic silver rounds, et cetera. And you can increase your position by, I increased one case of silver by 40% by doing that trade, right? Wow. So you sell the Silver Eagles and you buy the 10-ounce bars on a wholesale price, and you can make a huge, basically with very little risk. I mean, the only risk is the counterparties, is basically making sure that you get paid for the one you sold and making sure that you then pay the people that you bought it from. And there's very little risk in terms of making those trades within a very short time frame. So you have no spot price divergence. I mean, spot price didn't move much since. So yeah, that exists. If you have the right products, you can make those types of trades because sometimes the market runs into shortages. I expect in the future there'll be a time when Silver Eagles, just like we had in March, there'll be another shutdown and there won't be a lot of people clamoring to buy American Silver Eagles. And bullion dealers are going to have to offer a better bid price in order to have Silver Eagles in their inventory. And they'll turn and they'll ask their customer base, hey, we're bidding Silver Eagles at this price over spot. Anyone willing to sell? And there's an opportunity possibly there. Sometimes people will take some profits or at least capture the premium that's been widening out. Because being in this industry long enough, you kind of understand, like, when you go from crisis 2008 through various other times in the 2010s, there were a couple other times where the premiums in Silver Eagles got up, but they didn't get anywhere near fall 2008 until recently. We almost hit fall 2008 peak crescendo Silver Eagle premiums and shortages, but it wasn't that far yet. What we need to get further than that is we're going to need a real bank crisis or a currency crisis where people are clamoring not simply because they see the spot price low and they see a deal. You're going to want to see people going in there because you got to get me out of this. You got to get me out of this bank. You got to get me out of this currency. When you start seeing that, there's going to be absolutely barely any bullion to buy. And that'll be the time you'll want to sell into that because there'll be some incredible premiums to take advantage of then.
I couldn't agree more, James. As you were talking about all the resources on your site, you also have a great book for free download called The 21st Century Gold Rush, learning how to safely buy, sell, ship, and store physical precious metals. Is there anything else you'd like to highlight or anywhere else you'd like people to find any more resources on you?
Yeah, so that book is a free PDF. It's pretty large. I wrote it in 2017 in the fall. The one regret I have is probably should have gone and hired a professional editor to professionally edit and clean it up. But if you're someone out there who's getting into this first time, it's good to scan, good peruse. I'm not necessarily saying every word is going to be beautifully written. I more or less made it into something that was like a basic A to Z how to do. I wasn't trying to tell you a story. More so of like, here's the A to Z soup to nuts of things that you might want to keep in mind when you're getting into this industry. In terms of the YouTubes, I do every week a free video on YouTube, basically an update on what's been going on in precious metals and other related news. And so I basically curate. I spend a lot of time looking at what's been happening in the week and try and bring people a condensed version of what I think is the most important stuff. And so it's usually a 10-minute, 15-minute video tops. And so I'm respectful of your time. We're not going to go on forever in terms of droning on and on and on. I'm trying to condense it down and make it something where 10, 15 minutes, you get what's going on in the market very quickly.
Perfect, James. And you're also at James Henry AND on Twitter, correct?
That's correct. At James Henry and you can find me on Twitter.
Excellent. Thanks very much for your time today, James.
Yeah, it was a pleasure. Thanks.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?